Ever wondered what taxes you need to pay when buying a property in the UK? It's not just the price tag on the property that you need to consider, but a handful of taxes that come along with it. It's all part of the process, and knowing what to expect can help you plan better. The first item on our list is stamp duty land tax, popularly referred to as stamp duty. This is a tax you're required to pay when purchasing a residential property or of land in England and Northern Ireland, valued over £125,000. The rate fluctuates based on the property's price, starting at 0% for properties up to £125,000 and can soar up to 12% for properties exceeding £1.5 million. For first-time buyers, there's a relief scheme that significantly reduces the amount of stamp duty payable. If you're a first-time buyer and the purchase price of your property is less than £500,000, you pay no stamp duty at all. Moreover, it's important to note the additional surcharge for buyers who aren't residents of the UK. If you're not a UK resident buying residential property in England or Northern Ireland, you'll be subject to a 2% surcharge on top of the usual stamp duty rates. This surcharge is applicable irrespective of the value of the property. If you found this information valuable and would like to stay updated on more such content, make sure you subscribe to our channel and give this video a thumbs up. By doing so, we can continue to provide you with the information you need in the most accessible way possible. Remember, your support helps us to continue the work we do. So, don't forget to like and subscribe. For those purchasing in Scotland, you'll encounter the Land and Buildings Transaction Tax, LBTT for short. Similar to stamp duty, LBTT applies to properties and land over £145,000, with rates ranging from 2 to 12%. Meanwhile, in Wales, you have the Land Transaction Tax, or LTT. This tax applies to properties over £180,000, starting at 3.5% and reaching up to 12% for those properties priced above £1.5 million. Next, you might have to consider capital gains tax, but this only applies if you're selling a property that's not your main home. The rate for this tax depends on your taxable income. 18% for basic rate taxpayers and 28% for higher and additional rate taxpayers. Lastly, don't forget about the annual tax on envelope dwellings, or ATED. This annual tax applies if you own a property worth over £500,000 through a company, partnership, or collective investment scheme. In addition to the taxes we've discussed, there's another important tax to consider if you're planning on renting out your property: the tax on rental income. As a property owner in the UK, any income you generate from renting out your property is subject to taxation. This includes not only the rent you receive, but also any other income related to the property, like income from services you provide to your tenants. The tax is calculated on your profit, which is your rental income, minus allowable expenses. These expenses can include things like mortgage interest, maintenance and repairs, insurance, and agent fees. It's important to keep records of these expenses, as they can significantly reduce your taxable income. Remember, everyone has a tax-free allowance, currently $12,500 per year. If your total income, including rental income, is below this, you won't pay any tax. If it's above, you'll pay tax at your usual rate. Please note that tax laws can be complex and change regularly. It's always a good idea to consult with a tax advisor or professional accountant to ensure you're complying with all relevant laws and taking advantage of any allowances or deductions you're entitled to. Coming up next, we'll summarize all the taxes you need to consider when dealing with property in the UK. So, to encapsulate it all, when securing a property in the UK, a variety of taxes come into play. This includes stamp duty, LBTT or LTT depending on the location, and capital gains tax if you're selling a property that's not your primary residence. You may also face ATED if the property is held in a specific manner. Another significant tax to consider is the tax on income. This is calculated based on the profit made from the rental income after deducting allowable expenses. The amount of tax paid is contingent upon the total taxable income for the year. These can greatly influence the total cost of acquiring a property, making them vital elements to consider when budgeting for a property purchase. They compose the intricate web of the property buying process in the UK. Them is the first stride in making enlightened decisions when investing in property. Remember, the world of property taxes can be complex, and it's always a good idea to seek professional advice when dealing with such significant financial matters. That way, you can navigate the property market with confidence, knowing you've got all your bases covered.